Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, it would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to Loonie Hour, episode 152. As always, joined by the three amigos, Boomer, Keith Dicker, Rich Diaz, Ice Cap. What's going on?
Hey, it's the ever see the commercials? I don't know if it's years ago or months ago, where it shows that parents are waking up in the morning and they go, "It's the most wonderful time of the year." You see that
Viagra
one?
commercial?
No, it's the Bureau on Grow commercial. I love that commercial.
What did you call it? Steve was wrong. What did you say, Rich?
Bureau on Grow. Oh, sorry, I'm from Quebec. Staples, right? Is that what it's called in Ontario?
Okay, well, in my mind, it works differently than you two turds. Kids are back to school. So anyone who's listening, families, and your kids are back to school.
Man, I was way off with the Viagra commercial.
Yeah. Maybe that happens as well at this time of year.
School, it does make sense.
Yeah, like this little afternoon delight.
Yeah. Mrs. Ice Cap.
How do we start this? We're 30 seconds in and already the wheels have fallen off.
A lot of people turning off the show right now.
Oh dear. Anyway, everyone is gone back to school, whether you're young or in high school or at university, the college kids and everything. And it just feels different. But you know what the feeling is this time of year? Dun, dun, dun,
NFL
dun.
football.
Yeah, Rich is my favorite guy to work with.
I get it.
Football is starting up this weekend, so we have that
tonight.
Yeah, but the real football starts when the 49ers play. So
yes.
Yeah, we'll wait.
Are we gonna get a weekly update on the 49ers for your predictions?
Yeah. Last year, I think I was right 13 times. So because I predict them to win every single
13.
Week. Anyone who's betting football, actually, I know one of the guys who we work with. I think he's a professional sports bettor person.
Gambler.
Yeah, you don't want to say that one. But
He's a degenerate gambler.
Yeah, you don't drink wine, you enjoy wine, But yeah, anyone who is in it, they'll know what I mean when I say this. But week one, first 3 weeks of NFL, it's horrible for betting. You just don't know. Every team is different each and every year. However, the 49ers are going to beat the Jets on Monday night over in Levi Stadium, 27-16. There you go.
Very good.
There it is. You didn't even have to wait till the end of the episode. You get it early.
That's right.
You get it right now. There we go. What's new with Rich?
Episode 2. Episode 1 was extremely well received. So thank you very much for everybody subscribing. And I mean, episode 2 of the Ice Cap Canadian Market Wrap, our Loonie Hour spinoff, and something I'm really, really proud of. So episode 2 is released by the time we record this, because we record this on a Thursday. And yeah, I'm really excited about that. So if you haven't already subscribed, please do so. Otherwise, there's so much going on in the news and in the markets. And I think that's it for me, Keith. Nothing much other than that.
Sounds good. Steve, what about you? What were you doing on Labor Day
don't worry about me.
Yeah.
No, it's good, man. Just back from Labor Day, shenanigans, just hanging out, enjoying the last bit of summer, sitting on a lake. So
when does it start to rain in Kitsilano?
Never. It doesn't rain in Kits.
It doesn't rain in Kits.
In the west of it, though.
So when does it start to rain then?
The king won't allow it. The king won't allow it.
The weather's looking pretty good. Usually, kind of like mid, maybe third week of September, it starts to really change. But yeah, fall is in the air. The kids are back to school. The Viagra commercials are churning up, and the Bank of
This
Canada.
episode brought to you by the Blue Pill.
Yeah, that's right.
Bank of Canada's cutting rates again.
I've got my Twinkie.
I thought we all bet no cut, but anyways, Rich is gonna eat one anyways because he's carbo loading for the winter. But yeah, Keith, Bank of Canada cut as expected, 25 basis points. I watched a bit of the presser. I'm not sure if you followed along, but it seemed like first question everybody had was why didn't they cut 50 basis points? I don't know if you saw the announcement or if you were on the ferry again during it, but
Boo, boo, boo. I watched the presser from my desk, but quite literally 2 out of the first 3 questions, it wasn't, it started off with, hey, enjoy the moment, kind of a tone with it again. But yet there were still 2 reporters not happy with 25 basis points being cut. Because what do they want? I won't ask Rich. Rich is eating there now. What do they want, Steve? They wanted 50 basis points.
we want 100.
We want 100.
It was 100 on the way up. Should be 100 on the way down.
Yeah,
I was just happy they didn't ask the dumb questions that they always dumb. I thought the questions, Keith, were pretty good this month. But anyway, sorry, carry on.
Yeah, there was no surprise. They did cut by 25, so it had no impact anywhere really. What's interesting though is what do you have here? So we have 2 meetings left for the rest of the year. We'll go into their details, of course, what they say, everything. But just for everyone to realize, we have 2 meetings left for October 23rd and December the 11th. And what are the expectations right now for both meetings?
Cut, baby.
Cut, baby.
Cut, baby, cut.
Cut, baby, cut. So another 50 basis points. We have 7 meetings. Over the next 7 meetings, the market is now expecting them to cut 5 times. So by next July, the market is thinking the Bank of Canada will be down to 275.
Over the next how many? Sorry, say it again.
Over the next 7 meetings. 7?
3.
What?
425 minus 125 is 3. Anyways, carry on.
Market is expecting to be down at 275. So right now we're at 4%. Now we're at Loonie hour math, right?
Okay.
So 4% minus
the Bank of Canada. No. The Bank of Canada right now reduced by 25 basis points. So that the current monetary policy, the interest rate is at 4.25.
Right.
Okay. So we
No,
started.
we're at 4. We're at 4 now. We're at 4.25.
Worst episode ever. We're at
Yeah,
4.25 right
man.
now.
They hiked rates to 5%.
I got to go back to school with my math.
We're at
My
4
machine
we're at
is
4.25.
wrong.
The markets are expecting another 50 basis points by the end of the year. That's going to bring your overnight rate to 3.75.
Correct.
And we've got more cuts priced in for next year, Keith, 2025.
We have another 100 basis points priced in for 2025. Does that square the peg? That sounds a bit better,
There you go.
doesn't it?
Boom.
We finally got there.
Yeah.
So we're going to be at 275 by the end of 2025.
That math works.
I
No,
hope.
by July of 2025.
Yeah, exactly.
Okay. So that's pretty, I mean, it's a pretty aggressive in terms of the expectations. I mean, it seems like the markets are really expecting things to go a bit sour.
Well, at the same time, lots of people like to comment on the Bank of Canada. And so our Minister of Finance, she commented yesterday, she said, hey, this is great news for Canadians. Bank of Canada is cutting interest rates. Now, you ready for this next one? We were the first G7 country to cut rates in June and July. Now we are the first G7 country to cut rates for a 3rd time. You can't make that up. And that's not
Honestly.
a parody account. That's real. Right?
That's a real account.
Yeah. That's the
To be
real
fair,
stuff.
if I was a politician, I'd probably be tweeting the same crap. But I think those that are economically literate know that this isn't really a great sign of the performance of the country. we're cutting obviously because we're basically in a recession, Rich, at least on a per capita basis for what,
Yes, sir.
7, 8 straight quarters now.
Something like that. Yeah, it's not good. I mean, I think just getting back to the presser itself, I thought that was just a couple of interesting takeaways that I had was he mentioned a lot of slack in the growing slack in the labor market, which I thought was interesting. And I think one of the people who asked one of the journalists that asked the question that prefaced his request for 50 basis points in 25 argued that unemployment rates are rising, so there's slack in the labor market. The other thing I thought was interesting is there's more slack in the economy writ large, which I thought was also obvious. I mean, when you have GDP growing very slowly and GDP per capita falling, I think that was interesting. And then the final piece that I thought was especially kind of confusing was his piece that lowering interest rates would help the housing market naturally if mortgage rates go down, but that price increases in shelter and some other services would hold up inflation. And so, it's funny where he thinks that Canada's bread is buttered, which they want to save the housing market and sacrifice working class people in the rental market. I don't know. That's my interpretation. Maybe it's a bit too sharp, but I thought those were the 3 takeaways for me.
Yeah, just one thing on the housing side, because I think a reporter asked him, like, well, if you're cutting rates, yeah, you worried about house prices. And so, Rich, he mentioned that there's a possibility that house prices could push higher, but that shelter inflation would still come lower, which is kind of a little bit what you and I have been bantering about over the last, number of episodes, which is like the lagging shelter component, e.g., I think what we're seeing in the rental market, we'll get to that in a little bit as well, but I think we're seeing more and more evidence in real time that the rental market is softening, and in many cases, rents are declining in several of our major metros, despite shelter inflation suggesting that rents are still accelerating. So I think that's something to sort of keep an eye
on. Keith, I think you're on mute.
And here we go, yet another awesome Loonie hour moment. Apparently, I was talking away with some really brilliant observations in the Bank of Canada. And then both Rich and Steve said, hey, you're on mute. So now I'm not muted anymore. And what I'm about to say won't be as brilliant as a minute ago. But what jumped out for me, in general, though, the announcement, it wasn't really perceived to be, an incredibly awesome moment or very negative. It was what was expected. But what really jumped out, though, was, basically they said, the risk to the economy now is that the risk now is that the economy is too weak and that inflation could go down by too much or could decrease too much. And as Rich, you mentioned earlier, I think you used the word slack, or you did, Steve, refer to the slack in the economy. When you have slack in the economy, it means that inflation should start to fall, and like there is more supply available to do things with. So if that's the word they're using now, then that's their way in central bank talk of them absolutely saying, yeah, we're very concerned here right now that the economy is going to roll over hard and that we are likely going to continue to cut rates. That's why the expectations are, to get down to 275, by next year. But if the data does get even weaker, Steve, maybe we get that magical, 50 basis point cut coming up. That could happen. But that's the direction we're going. That's what I read into it.
Yeah. So keep in mind the increase of the weakness in the labor market that they're citing coincides with, of course, the federal government's actions or delayed actions to reduce the temporary foreign worker program. So basically, again, that temporary foreign worker program basically shuts off now when unemployment rate is 6% or higher. And so we're kind of there in many parts of the country. So, but again, that's kind of the delayed reaction, Rich.
Yeah, I just think it's, again, just to reiterate, not to like pile on to our dear finance minister, but just it is interesting that I think the interpretation is almost exactly the opposite of what it should have been. And I think that that's just important that people understand. Keith is right. You've got that excess. I mean, just to read again what they say, I would just encourage everybody once in a while to just Google it. Maybe that's asking too much. I'm the only nerd out there, but excess supply in the economy continues to put downward pressure on inflation. And I think that that's really what they're worried about. It was one more thing I thought was interesting was that they did actually push back against the argument that they should cut more, because I think that their view is that there are still risks out there that inflation does increase. And I think 3 or 4 weeks ago, I mentioned that like producer price indices, when you exclude oil, so core PPI, has actually started to increase again. And so that's this balancing act that they're trying to do all the time. And I think it's a difficult job, and mistakes have been made, but I think that they were right to just be steady as she goes, to lower interest rates. And yeah, we'll see what happens. It'll be interesting to see how the market sort of reacts with respect to future expectations.
Well, with market reaction, what's really jumping out to me right now is, so the 10-year dropped by almost 15 basis points over the last 3 days. So 1.5. And so that's a pretty big market move. Remember, the 10-year almost hit 4% back in April. So in May, June, July, and August, right? 4 months.
Yeah.
The 10-year in Canada has dropped by 100 basis points. And what does that signal? It's
the
slowdown.
word.
Yeah, the
Recession.
R word. Yeah, absolutely.
Recession.
Yeah.
Hey,
Yeah,
to that effect, so just on the housing and mortgage rate side, so the Bank of Canada, of course, reducing rates. The misnomer, I think, in the market is like, well, wow, housing's going to take off. And again, keep in mind the Bank of Canada's, by changing, cutting rates, it's really mostly just impacts variable rate mortgages. And so variable rate mortgages today, your prime rate is now about 6.45%. So that kind of takes most banks will go, okay, your prime minus 1% on your variable. So your variable rate mortgage is going to be about 5.5% today. So assuming we get the 50 basis points of cuts by year end, most people's variable rate mortgages will be about 5%. We have fixed rates today. We're actually seeing quite a bit of discounting on the fixed rate mortgage side, Keith, which coincides, of course, with the movement in the bond market. I've got clients getting 3-year fixed rate mortgages at 4.3. 4.4. Like, we're seeing banks get pretty aggressive actually now competing for business and actually, basically trying to acquire clients. And so they're being fairly aggressive in their rate reductions. And so, if you can borrow a 3-year fixed mortgage at 4.3, and by the end of the year, your variable is still at 5, like that, you know what I mean? So like there's not going to be that many people that are really going to be opting for variable rate mortgages. So I don't necessarily think that's going to influence demand, at least from a borrowing capacity perspective. But I think it's interesting. Like I'm starting to look at this and say, okay, the big concern for a lot of Canadians was the mortgage renewal cliff, right? All these people that were borrowing at 2.5%, 2.8%. that are coming up for renewal. And the concern, 6, 8, 10, 12 months ago was, well, fixed rates were at one point, they were 6%. Then they were 5.5%. And you're like, wow, someone's going to come off at 2.5 and renew at 5.5. So I start to wonder, well, if you're coming off at 2.5 and you're renewing at 4.3, 4.2, 3.9, I start to think that might be manageable for a lot of households, truthfully. I think there's a much, much bigger concern renewing at 5.5 or 6 than it is renewing at 4.1. So I think that's to take the counter argument. I mean, of course, it's going to depend on employment, the labor market. Are we going to see a hard landing and job losses? Of course, that would impact things. But I think, strictly speaking, on the rate renewal side, I think it's becoming a little bit less of a concern.
So hearing this, I don't think anybody has a clue where we're going right now.
No, it's true.
So, and what I mean by this, and again, there shouldn't be this much volatility in rate expectations across any market. Doesn't matter if it's real estate or in any part of the yield curve in the investment world. But so you're saying that we've gone from 4% for what a 3 or 5 year, from 4%
I'm
up
going
to
basically on
6.
I'm going to go off 3-year fix because that's really since rates started going up. What 2.5 years ago, everyone basically essentially pivoted from variables and 5-year fixed mortgages to basically the 3-year because that's kind of where the sweet spot has been on pricing.
So the 3-year went from around what, 4% up to 6, and now back to 4 again
well, I mean, obviously at one
in
point during the
that
depths
area. Do you know what I mean? Is that right?
Yeah, it's basically been fluctuating between about 4.5 to, I think it got as high as about 6.2, 6.3.
Sorry to interrupt the show. A quick message from our sponsors. Ever been lost abroad searching for Wi-Fi and all you found was frustration? Introducing Saily eSIM, the ultimate travel companion brought to you by Nord Security. With Saily, you can avoid outrageous roaming costs, compatible with both iOS and Android. Saily is so easy to set up. First, download the Saily app and install your eSIM with a simple tap. It's quick, easy, and hassle-free. Next, choose a plan that suits your travel itinerary, whether you're off to London, Mexico City, or visiting Rich's family in Portugal. Saily has a plan for over 150 countries, and with a variety of options, you can find the best rates that match your needs and the duration of your trip. Activate the eSIM before you travel and connect instantly when you land. No internet required. This ensures you're ready to go as soon as you arrive. With Saily, you stay connected wherever you are, cut those fees, and enjoy 24/7 chat support. No more waiting in airport lines or dealing with sketchy SIM card sellers. Just download once and you're good to go. So easy, even the boomer can do it. Go to saily.com/LoonieHour and use the code LoonieHour to get an exclusive 15% off your first purchase. Link in the description below. And now, back to the show.
In such a short, compressed time frame. And that's my point where I say, I wasn't joking. I'm being truthful. Nobody has a clue where this is going.
Yeah.
I think everyone, including the banks, of course, they're the commercial banks, that is, they have capacity. They are going to lend. They absolutely will lend. The price is just a function of what they need to price it at, to compete. That will happen. And again, I think we are headed for this. If everyone had the expectation that rates were going to go from 2, 3 up to 6% and then up to 10%, 12%. Do you know what I mean?
Yeah.
Then all of a sudden it's no, that's now called off. Now we're going back the other direction, 6 down to 4, down to 2, and whatever. The expectations for rates right now today, and the expectation for economic growth, not only in Canada and elsewhere, I betcha. Don't you love that word? Betcha. I betcha. I just like
Get
the
on
word.
with it.
Okay. I betcha by the time, we get through the fall, we get through November into December, expectations are going to be completely different again where we are today. But that's just my because again, none of this makes sense. Everyone was lulled to sleep for over a decade with no price discovery on the yield curve. I mean, that didn't happen. And, that's what caused the asset bubble to really inflate here in Canada. And, we have that happening. But again, I just sit back and look at this and say, like, holy smokes, this sure is a fun time to be a money manager. I think it is.
I agree. And just to sort of just jump back 1 or 2 steps to what Steve was saying, I mean, you're right about the renewal piece, which is that when the Bank of Canada did their modeling, I think variable rates, they had expected variable rates to sit around 5.5 or whatever, and then if that's going to come down quicker than they had modeled, I guess then a bunch more people will be able to absorb that increase in mortgage rate. But there's 2 little wrinkles to that, which is there's a sort of I would say dumber, slower way of sort of assessing that risk. And there's something called the debt service ratio. And the Stats Canada publishes this every quarter. And you have, different types of debt. And obviously the debt service ratio is how much it costs to service that debt, which is interest and capital relative to your disposable income. And that is basically still at an all-time high of 14.91%. I think the all-time high was 15% or whatever, 1500. And so the problem is that twofold. Number one, because we have so much more debt just in total relative to GDP than we did, let's say 10 years ago or whatever, than the last time you had sort of a collapse in mortgage rates, that you have the relief that you get will just necessarily be less than you will have this time. And the other piece that's really important is what Keith always says, which is, we still, and you alluded to this, Steve, which is we still haven't really priced in, or we haven't really acknowledged if you have like a hard landing or a collapse in, or not a collapse, but a decline in employment, which affects the disposable income part of that equation, or that quotient. And so, your debt servicing ratio, the debt service obligations might be relatively muted because of falling mortgage rates. But if your disposable income starts to fall, then that debt service ratio will actually go higher still, which will further compound the problems with consumption, GDP growth, etc. And so it's just something to keep an eye on, I think, too.
Yeah, no, and I think like just to add to that point, I think on the mortgage side, like don't get me wrong, the even if rates are at, let's say, 4%, I mean, that still kind of, in my opinion, still hampers the investor bid, which has been a huge influence on the demand curve for real estate over the last 3 to 5 years. So like most of these investment properties just aren't really going to work at 4%. So like I think you're still looking at a weaker demand on that front. And then like, the Bank of Canada's cutting, right? 75 basis points so far, let's say another 50, so 125 basis points. People that took out variables near the lows, I mean, they're still in really tough. Like they're still kind of screwed. So it's not like, to your point on the debt servicing ratio, it's not this huge easing that we're used to. So there's still going to be challenges there. I'm only saying hypothetically, if you have kind of like a low 4 on the renewal side, I think for a lot of households it will be manageable. But again, that's not to say there's going to be no pain, et cetera, et cetera, et cetera. I just think the worst of the concerns, which is, again, I think people renewing at 6 is a much different conversation than people renewing at 4.
Yeah. Fair.
So what you're saying then is that, there's a little bit more love coming back.
A little bit.
You know what's funny? If your spouse looked at you the same way as they looked at the Bank of Canada, that would be amazing.
Yeah.
People love
What does that mean? Oh my God.
Well, maybe it didn't come across quite right, but you keep going back to, everyone is just hanging on every word from the Bank of Canada. When they're raising rates, you hate them. And when they're lowering rates, oh, you love them so much. You can't believe, you want to get all snuggly with them. And I look at all of this combined, and it's still one of these things. That's actually one of the big short moments at one point. It's like holy smokes, you still have faith and belief in the system. Do you remember that in the show or the book? And or the audio book. You have the audio portion.
But Keith, there's another piece to it, which is that Canada's still obsessed over, sorry, Steve, a relatively non-productive asset. Instead of driving and putting all of our emphasis into capital investments and structure and intellectual property, research and development.
Man,
shut your face, Rich. Shut your face. Steve, I'm picking up for you, man. I'm picking up for you.
Everybody wants to know when the housing bull market's back.
Yeah, exactly.
Baby.
It's like, instead of building and creating things, we're basically just playing a leverage game, which is not sustainable.
Man,
and
I have to chat with home buyers and sellers every single day. It's what I do for a living. And just the amount of sellers that are like, oh my God, rates are getting cut. Like I'm not lowering my price, and I might even raise it. And I'm like, you know what I mean? It's exhausting. I think everyone's just so mentally ingrained that like every downturn is short lived. Now I always think like, we'll see. I'm not sure how this is going to play out, but it wouldn't surprise me. Like, hey, what if home prices just stagnate for a decade like they did in the 90s? And so I've always tried to sort of like at least prep some of our clients for that scenario. I mean, I look at Vancouver, just had the latest data out for the month of August. Rich, home prices are down. So like if you have these extreme examples, right, which is like what people post on Twitter and stuff, which is like, oh my God, this idiot bought at the peak, he overpaid, he got into a bidding war, he paid way over, and now he's reselling and he's taking a $400,000 hit. Wow, prices are down 30%. And that's just like the one-off case. If you look at like home prices, whether it's the median home price or the benchmark home price, Vancouver home prices from the peak to where they are right now in August, as of August 2024, they're down 5% from the peak, and they're down 1% over the last 12 months. like
So flat, basically.
it is flat. It's just not a very exciting. It's not a good housing market. It's weak. Sales are well below long-term averages. There's a lot of stuff that's going no bid. But in general, like prices, I mean, they haven't really moved that much when you really consider, I think, how crappy the economy is, number one, and how much interest rates have moved. So we'll see how it plays out, but I think it's a relatively boring market. And then you go to these extreme examples where you hear of these massive corrections in, you know, in the Brampton housing market and these far-flung suburbs of the GTA where there was just so much speculation. Doug Hoyes, who runs a debt consulting business, he posted this one story, I think from some of their clients, and actually from one of his Brampton offices. He goes, some guy bought a pre-construction house at the peak in 2022. So he bought a pre-con house in 2022 at the peak for $1.85 million in Brampton, put a $240,000 deposit down. So closing was delayed due to arson, apparently. And so the house is now worth closer to about 1.3 million. So again, he paid 185. It's now worth about 1.3. Due to the reduced appraisal value, the buyer can't get a mortgage for the full amount, so he can't close the deal. The builder has now listed the house for sale, but there's been no sale so far. And the builder just issued a statement of claim for $500,000, which is the shortfall between basically what he originally sold the house for and what it's going to sell for today. So the buyer's getting sued. So it's just a great example, right? It's like there's these extreme examples on Twitter, but I don't think that's necessarily the norm. So yeah, it's interesting.
But that's probably misinformation or disinformation.
Oh no, we're gonna be banned.
Yeah.
Well, there's lots going on. Did you guys see the story on the Canadian universities in these university towns? They're all complaining now.
About what?
Well, I mean, again, to some of the Loonie hours, I think encouragement, the federal government, of course, changed their policy stance on foreign students and temporary foreign workers. And so what they've done is, of course, the cap for 2024 for study permits was reduced by 35% across the country. So basically, there's fewer foreign student enrollment in these university towns. And that does not bode well for these landlords that were piling in, 5, 6, 7 students into these houses. And so there's all this outrage in an article in the Globe and Mail showing that houses that were previously renting for $4,000 a month are suddenly now going for about $2,700 a month because they can't find students to pile into these houses.
I'd say that's a good thing.
Sounds like deflation to me.
Yeah, that's
start
right.
cutting.
But isn't it funny though? Because usually you always view everything from your own perspective. So if you're looking to buy a house, you're viewing it from, okay, what's it going to cost me to buy it? How much we need to put down and so forth. So when we had these struggles, I think people know in the college towns, it's hard to find a place for your kid to live. Like it really is a struggle. So that's their perspective. Prices are too high. You need them to come down. They come down. Now who's complaining, Rich? Who is it?
The landlord.
Yeah, it's the owner.
holder.
It's the asset owner. Yeah, absolutely. And it's not that one side is right and the other side is wrong. Like it is what it is. But quite often people don't realize. I find, I think this gets lost in the conversation these days with housing and coming from policymakers and so forth. Like it's almost like they're trying to penalize the private sector for buying property and developing it and so forth. Because the only way to get the prices to come down then to benefit, effectively the renter and the buyer, the loss for that is being borne on the other side. So I don't know if this is coming across the right way, but my point is that if there's a winner, it means there's a loser somewhere else on the ledger that we're looking at here. And if they had to borrow to invest to renovate those properties, Steve, then maybe they can't make a payment or two. What happens then in the accounting world at the banking side?
The loss.
Yeah.
Provisioning for loans. Yeah.
Oh, yes, of course.
Yeah. See how it's all connected. Like it's a big circle here when you look at it.
I'm surprised the Globe and Mail took this angle because to reiterate Keith's point, the angle should be is, oh, finally we're getting rental relief from policy changes directly related to our massive immigration mix up, you know what I mean? And that would have been, I'm surprised they like took not the side, but
thanks
you
a
know what
lot,
I
man.
mean?
We're definitely not getting any more ad sponsorships from the Globe and Mail. This is like the third time you roasted them.
No, I mean, I actually, since I roasted them, I actually really like the Globe and Mail, to be perfectly honest with you. But anyways, should we switch gears?
This episode brought to you by. But I know of several universities down here. You read the stories, of course. Their allotment for foreign students has been cut dramatically. There's one school down here in the Maritimes. I think it's University of Cape Breton or Cape Breton University, one or the other. My number might be a little off, but guess what their percentage of foreign students is?
50?
Prior.
Oh, more?
80?
I mean, come on.
Yeah, it's like 80, 85%.
They
Like
located above a Burger King.
It's no, I think there's a lot of government money going into that part of the province.
Speaking of government money.
But wait a second though.
Yeah.
But because their numbers got compressed so much, because of the reduction in foreign students coming in, it didn't work for them. So they actually received a what would you call it? A reprieve.
Bailout?
Well, if you want to call it, you can call it for what it is.
Bailout.
But they're allowed to bring in a little bit more than what they were originally told that they couldn't. And I think that's happened with other universities right across the country as well. So
it just tells you that these universities shouldn't exist. I mean, that's the market's broken and the market needs to correct. And some of these universities just shouldn't exist. If their entire model is a 100% foreign students, they should just move to the country.
You ever notice that in Canada, it's like nothing is allowed to fail?
Yeah.
It's like housing can't fail, a bank can't fail, university campus can't fail.
Steve, do you know who believes that? Do you know who believes nothing should fail?
Uh-oh.
Say it. Come on.
The commies.
The commies. That's right.
We're getting grief about that from some of our Loonie Hour faithful.
The commies. It is
what
it is.
Well, speaking of the commies, Jagmeet Singh, he has disbanded his relationship coalition with Justin Trudeau, the feds. So
that's a big deal.
It's a huge deal.
Yeah.
Or is it?
Apparently,
he's certainly thrown some meat at the animals out there.
Okay, no.
Jagmeet.
Oh boy,
there's a laugh track. Jeff with a laugh track.
Oh man.
But I mean, wait. So can I ask just an honest question? Which is this a superficial thing, or is this like a real thing in the sense that by pulling support, does that trigger sort of like the end of this parliament? Or is it just that he's now no longer having to slavishly approve everything that JT wants to do?
Yeah. I mean, there's two sides to the argument. I've been going down the Twitter rabbit hole and kind of looking at all these really good accounts that are actually plugged in, connected, and know this stuff better than I do. So there's kind of two stories you're hearing. I think one is it seems quite clear that the Liberals were in fact blindsided by this. So I don't think it was like, hey, this is what we're going to do. I think it was genuinely blindsided. And then number two is that, it could be part of political positioning for Jagmeet, which is to say that, hey, I'm no longer supporting this coalition and this guy, and I dislike him, and sort of setting himself up for the next election while still kind of voting with them on each item and not actually, calling a non-confidence vote basically.
Yeah.
So that's possible. I guess we'll wait and see, right? I mean, we'll see when. I think they've got a couple policy measures, I think, coming out in November that'll have to get voted on. I think they've got another budget coming out in the spring of next year as well. So there's a bunch of items coming up, and we'll just have to see where NDP Jagmeet leans on those items.
So we'll see. I think the point is, though, now if he wants to make it happen, he can do it, because it's step one. First you have to admit who you are, right? So that's now once you admit who what the price is, then you know what you are.
I can't believe you said that. Oh, that was a good one, Keith.
Oh,
You screwed up the other one, but that
dear.
was genuinely a really good joke.
And that one came out okay. That one
Yeah, it was
delivery was
good.
okay.
Keep going.
Yeah.
Sorry, I'm sorry. I laughed too
Okay,
much.
yeah.
You're on a heater right now. Keep going.
But I think though we know where this is going. I mean, obviously now the stage is set that if the NDP, if they do want to trigger an election, they now already set the path for it to take place. So whether it's when they're back in Parliament soon, I know a lot of people talk about the magical February date. So when Jagmeet will earn his full pension. I don't know if that's truthful or not. People can share with us if it is. But you have that floating around out there. But it's the first step.
It's going to get spicy. The next year, it's going to be, I mean, it has to be, right? I mean, NDP's polling, I think it's a 4 or 5 year lows. Conservatives are basically at or not all-time highs, but very, very, very high. And it's just going to be amazing to watch sort of the political jockeying that we're about to. I think it's going to get really hotted up because in general, I think Canadians spend way too much time looking at American politics, and we're in the next couple of months, that'll be spicy too. But I think for the first time in living memory, Canada's politics is, I think, genuinely interesting, just from a dispassionate, agnostic sort of point of view. I think there's lots of backstabbing and jockeying and
So
changes afoot.
Where would that rank in the G7? I think
know.
they're all tied for one, maybe.
Yeah,
one of the seven.
they're all
Hey,
tied.
Keith,
but-
you are right. So for Jagmeet Singh, he's eligible for his full pension in February 2025.
Should we make a Twinkie bet?
That sounds like a Twinkie bet.
Yeah.
Is he pull it or not? We'll think about that one.
If he lives until age 90, his total pension payout could reach 2.3 million. Annual pension value 45,000 per year, starting at age 55.
Oh, that's not that as much as I thought it would be.
I don't know. This is
Yeah.
from Perplexity AI here, so it could be slightly off, but those are the numbers.
Yeah,
So what
but
else
as
we
Rich
got?
said, it's not. Yeah, what else we got? Oh, wait, guys, I almost forgot. Every now and then, I think once or twice a year, IceCap offers we'll do a webinar for people who want to attend, listen to the Loonie Hour. So a couple of weeks from now, we'll be doing it, and we'll let you know more hard details about it next week. So let us know if you want to attend. We've done it before. We had a lot of people, a lot of fun. You get to hear some really cool market views, or maybe some not so cool ones as well. I just thought of that then.
Since you're hijacking the show with plugs,
Too many
we've
plugs.
we've also got the Loonie Hour live event in Ottawa with a good friend of the show, Ben Rabideau. So that will be September 14th in Ottawa. Rich, where's the venue again?
I can't say it. You have to sign up for the tickets.
Well, anyways, there's a event.
Oh, you could have the crashers, right? The gate crashers.
Yeah,
could
we don't want the
happen then.
gate crashers.
You don't?
right. Whatever.
We do.
Anyways,
just
there's an
DM Keith for the details.
There's an event. Yeah, DM Keith. There's an Eventbrite link in the show notes. We only have 10 tickets left, so it's open to 65 guests is what we've the capacity, venue capacity. So we got 10 tickets left. If you listen to the show, good chance they're probably already gone. But there you go. Boomer. Back to you.
Yay.
All right. Back to the
me.
plugs. What else?
As I was
There's loads
saying,
Anything else we want to sell? got
no,
t-shirts,
couple
T-shirts
of the
on
market.
website.
Yeah. Actually, let's go back to the market. It was a pretty interesting announcement from OPEC today. So I think 2 weeks ago, OPEC announced that they were going to increase their production by X barrels a day, whatever it's going to be. So it was increased supply coming online. And WTI, West Texas oil, has gone from, where are we now, Rich? We've gone from about 80 down below 70, like very quickly within a week. And this morning, out of the blue, OPEC came out and said, well, my bad. We will now no longer increase production coming up because oil has gone down too much. And a real interesting, something that we should look at some time, and Rich, you can do a deep dive maybe, It's for people to understand and appreciate the fiscal position for Saudi Arabia.
You beat me to it. Go.
Am I? Okay, yeah, you can jump
it's
into
great.
that someday.
No, great.
Yeah,
Good.
but a real quick 30 seconds on the Saudis and their oil production and their revenues coming in. Like they're also running I believe they're running huge deficits. Is that correct?
No, they
Rich?
just went deficit and that's a big deal.
Yeah, big deal. Yeah. So they need prices to stay, somewhat high, whereas before it didn't matter. But that's something and again, remember the whole world is connected here. That is affecting, oil, of course, which affects us here in Canada with the only true export we're doing, from what I think Rich has told us about before. It's on the energy side. But that did catch my attention this morning. It was a pretty big U-turn, which you don't see very often from the OPEC.
Yeah, what else? What else you keep an eye on? It seems like there's been a lot of volatility in markets this week here, post Labor Day. Keith, the stock market's kind of bumping around, down 2% already this week.
Yeah, so. I know a couple of weeks ago, I sort of cryptically said, we could have some explosive movements coming up in the fall. A couple of the models we use, they were suggesting that we could start to see risk accelerate now after Labor Day. And when someone says risk accelerates, that means there's losses, by the way. It's just a nice way of saying it. So, we're only day 3 here, 2 out of 3 days, equities have been down, but the bond market has done really well. So it depends how you're measuring risk in this world. But I think now the focus has changed from rate cutting. Rate cuts are good, they're awesome, to okay, why are we cutting rates again? What's happening? Now we're going down, the whole, sort of slower growth mode. But the tone has definitely changed here, and people should be aware of it. It's kind of like the housing market, right, Steve? We go through 15 years of it never goes down. If it goes down a little bit, it seemed to be crashing. People have been sort of lulled to sleep with equities as well, saying, hey, equity market should never go down. But just a reminder, the moment you invest in the stock market, you should know you are implicitly signing up that any year you could make 50%, and any year you could lose 50%. Like that's the game, right? With the stock market. Doesn't mean you stay away from it, but you just need to be aware of moments when, risk is set up, to go in the different direction. But that's what I'm seeing there. How about you guys? Anything different from that?
The thing I thought was interesting is something we also highlighted, I think 4 or 5 months ago, which was like the internal rotation. And so before this couple days of decline, we talked about how, or something I had been keeping an eye on was the shift away from big tech or the Mag 7 or Mag 8 or whatever number it is. And how you might, even though the market might stay relatively elevated, you might get an internal rotation. So other sectors that have been otherwise unloved start doing well. And we actually saw it at a point just a couple of weeks ago where the equally weighted S&P 500 index actually hit an all-time high when the Magnificent Seven, the Google, Tesla, Nvidia, anyways, the other ones, Apple, anyways, that actually started to anyway, so that started to come down quite a bit, and I thought that was just a really interesting sort of, it just sort of speaks to that people are sort of moving, I think, into more defensive positions. I think, and it's also related to obviously the cut. It used to be a sense where cuts were good for for that Mag 7, for those long duration tech assets, and now all of a sudden cuts aren't as good for those long duration tech holdings, which I think is another interesting wrinkle in what we've seen the last month or so.
Because it does reconcile. If we have the long end of the curve, so if long-term yields are going lower, which is signaling, for all purposes, recession basically. And by the way, I do know the yield curve is steepening. If anyone's that deep into it, but that's just because the short rates are going down faster than long rates. But that with equity selling off, if you're BNN or Bloomberg or whichever else out there, you need a narrative to why things are moving. That could be it. But Rich is correct. You are getting a shift or a rotation between high beta, low beta sectors and so forth. You mentioned the Magnificent Seven. I counted 4. I don't know who the other 3 are. Who come up with
Microsoft? No, yeah. I screwed up. I can't remember. But the other thing I think is really interesting is the JOLTS data, and so that reflects the changes in the tech sector. So I mean, 2 years ago, so the JOLTS data came out. It continues to obviously drag slower. It's propped up by government job openings, among other things. But what I wanted to mention was like, so they also have openings for coding and job availability for like coding and software developers. And that's something that's really changed over the last little while. There really is sort of whether it's because of perplexity in AI or because of the natural cycle, you're having sort of a real change in that sector. The problem is, though, Keith, is that the earnings continue to be really, really strong. And so so I don't know how people are going to react. Is it going to be a valuation thing? Is it going to be a liquidity piece, like you always say? Is it going to be worries about a recession? Because, but in the sense that it's like sort of a bunch of different, strings pulling all at one narrative, and it's not clear who's winning at this stage.
So one other data point, I know we're getting closer to the end, but jokes aside, today is Thursday. By the time you're watching this or listening on Friday, the next biggest number of the year is coming out. So the American non-farm payroll number comes out Friday morning at 8:30 Eastern. What's the estimate for the US one here?
Beat me. I don't know.
We've also got Canada jobs tomorrow, right?
Yeah, we have the random number generator coming out as well. So the American jobs number, the estimate is 465,000. Remember, a couple of weeks ago, we had that big revision. I think about 850,000 jobs magically disappeared and stuff. Don't get bogged down with what the actual number is. And instead, is focused on what's the expectation. Is the economy growing? Of the reported number, does it look, is it more government jobs or private sector? Are they full-time and things like that? But yeah, Steve, you're right. We have the Canadian number coming out as well as the US number. So, tomorrow could be a nice rock and roll day heading into the NFL Week 1 weekend. With you get more.
Boomer, are you on a fantasy
cool
team? You playing fantasy?
I'm in the Bayman Football League fantasy pool. So if you know Newfoundland, you know what the Bayman is referencing.
How many people?
There's five of us. There's myself.
People? Man, you need a bigger pool, mate.
Yeah, there's me and Darren and Glenn and Scott and Chad. So
from Saskatchewan.
No, Chad is in Timmins, Ontario.
Oh,
yeah, it's pretty
Scott,
cool.
is that the guy that crapped his pants?
Oh, that's a different Scott. That Scott's from Winnipeg. This Scott is from Carbonear. Yeah, it's a whole different world, guys. So yeah, every 5 years I'll win it.
Yeah, this Scott doesn't crap his pants. The other guy does.
There's one more thing before we sign off, which is, we spend a lot of time talking about the negatives, and indeed that is the part of the cycle that we are in Canada. And so I don't think we should shy away from it. However, there was, in my view, an unambiguously positive data point that's come out. And in the past, I've been really, really critical of Canada's lack of spending in research and development, both from a public sector and the private sector standpoint. And what I thought was really an interesting data point that came out is that it's starting to rise. It's starting to rise after almost 20 years being flat in real terms and falling to about 1.2% of GDP. We're starting to rebound. So as GDP is stalled, research and development spending has started to rise, but it's rising in real terms, and it's being supported by both the private sector and the public sector. And so I think that's a really, really good change in direction. It's an important inflection point. I've said it before, and I'll say it again, productivity is the only thing that matters, and how you increase your productivity for a country is largely through CapEx, and especially research and development. Hopefully Canada can do a little bit more in the energy sector, but nevertheless, I think this is just a really, really good data point that we wanted to highlight.
But didn't we see a productivity number this morning for Canada that was going in the wrong direction?
Yeah, Rich is making stuff up.
No. I mean,
I think Rich is flirting with someone out there. Maybe that's what's happening.
I mean, listen, the data is the data. What am I going to do? You can Google it if you want to, but it's going up, and thank God it's going up in the private sector. I think that's the other thing. I think it's one thing for the government to research all kinds of silly things that we may or may not approve. I think it's a totally different thing when private individuals and private companies stake their own money to and research and development, software, equipment, etc. I think that's unambiguously a good thing. And like I said, after 20 years of it being flat, thank God it's going up again. I think it's another thing that's important to remember.
Well, that's like a good place to end it. Yeah, Ottawa, 10 tickets left. Eventbrite link. But yeah, anyways, we're done plugging for the day. I think we've done too much today. But as always, guys, we appreciate the support, and we'll see you next week.